Hello and welcome to MSDynamicsWorld.com's Fall 2013 Manufacturing Webcast Series. I'm Jason Gumpert, and we are happy to be joined today by Manufacturing and Life Sciences ERP expert Bob Bergman. Bob is a Microsoft Dynamics NAV specialist at Archer Point, and many of you probably know him from his years in the community and from his blog on the Archer Point website, where Bob dives into a wonderful range of manufacturing-related capabilities of NAV. And I highly recommend you check that out if you're not already familiar. Today, we invite you to add your feedback and ask questions as Bob gives this presentation. And you can use the Q&A block that you see to the right side of the webcast session here as a place to enter your questions. We will be sure to leave some time at the end to get to those questions. So, without further delay, please allow me to welcome Bob Bergman.
Thank you, Jason. And thank you, Mirko, for that nice comment you put over there in the chat screen. By way of introduction, I've been working as a Navision consultant for about the last 16 years, primarily in manufacturing and distribution. And for some reason, I had some success in cost accounting. And it seems to me now that cost accounting has become one of my more active roles. So with this webinar, what we want to do is to just maybe share some of my ideas or other people's ideas on how to set up Navision manufacturing cost accounting with an idea of being successful. Right away, we have to understand that there's no set way to do cost accounting. One time I was challenged by a client that said Navision is not GAAP, generally accepted accounting practices. He said Navision is not GAAP, and so I went back to the books to look to see what GAAP was for cost accounting, and there really is no GAAP for cost accounting. Cost accounting is largely managerial accounting, not financial accounting, and we'll get to that in a second. Financial accounting really boils down to knowing what is the inventory value for the balance sheet and to be able to audit that and correlate that to the inventory subledger. But when it comes to managerial accounting, what we're trying to do, and I learned these words, is to give actionable information to to management. So what we're trying to do with cost accounting is to, in a way, provide information that is useful to management so that they can make a decision one way or another. For instance, purchase price variance. If we're using standard cost, we might want to be tracking that purchase price variance to see are we paying less, or are we paying more for the materials than we thought we were going to pay in the beginning. Material usage variance says, here's my bill of material, here's what I actually used in production, and is it different than what I thought it was going to be? And if yes, then management has to take some action either to work on the quality and efficiency of manufacturing or correct the bills of material if that's the problem. Labor efficiency variance means that in our routing, for instance, we call for 1 hour worth of time in the production order. But if it takes more or less than that 1 hour, then we want to know that. And again, we're giving that information to management so that they can make a decision and hopefully make a change. For instance, training for the labor force, setting up the work centers differently. So we've given them, we are overusing labor or underusing labor, and then based on that information, be able to make a decision as to what to do. And here's one a little bit more hard to explain, but burden absorption means that we have all of the manufacturing expenses that are coming into the system. And the question is did we take all of those to the balance sheet with something called burden absorption? And what that means then, if we are under absorbing, it's either because our production rates are slower or we've set our rates wrong, which then would give us a false sense of what our manufacturing margin would be. Another way of looking at it too is that with Navision dimensions, we can analyze profitability by product line, for instance. It would be real easy to do, go to each of the item cards and say product line dimension equals 123, and then take that to analysis by dimension. Margin analysis also then, and I say margin analysis because it's a little bit more difficult to get that deep into the P&L. So margin analysis by territory, salesperson, customer, or whatever else you want, product line. So we're providing, again, management with actionable information that they can make judgments and hopefully make changes to their company to increase the profitability and efficiency. The hard part about coming into a company as a cost accounting consultant is understanding the vocabulary that's used. It doesn't seem like there's a fixed vocabulary. And if we look at all of these words, then labor rate, burdened labor rate, recovery rate, standard labor rate, et cetera, et cetera. And even where I've highlighted in this orange color, I've got the word burden absorbed, capitalized manufacturing expense, liquidation. Those all mean the same thing. So when I go into a client, and if anybody knows me on the call, it's quite uncharacteristic. I'm quite quiet for a while because I'm listening to find out what their vocabulary is. And once I know that vocabulary, then I can map it back to what I would call my vocabulary, standard vocabulary, so that I can understand what they're doing. If we look over in the right column here, there's a big confusion as to what is WIP, what is work in process, and then what is WIP items. And so somebody will say that's WIP, but what they really mean is that it's perhaps an intermediate or subassembly setting in inventory, like a subassembly here. So what I have to do then is to understand what they're talking about when they say WIP, and then to differentiate between WIP being what's worked on and WIP, which is subassemblies or intermediate setting in a stockroom. As we start to understand the Navision inventory valuation process, we take a look first at, it says process transactions that affect inventory. Regardless of setup, some transactions always post to the GL immediately. And for instance, if we invoice a purchase order, that hits the general ledger AP and something called the purchases account right then and there. If we invoice a sales shipment, we get a debit to accounts receivable and a credit to the revenue account immediately. So when we're in the, let's call it the financial side of the transactions, those transactions immediately hit the general ledger. But on the inventory side, there's a process that we have to go through in order for the information, the monies to hit the general ledger. And one of those is a program called Adjust Cost that I'm 99% sure everybody's on the call has heard of that program before. And saying, depending on the setup, it can be automatic or run as a batch job. Hooked right to that program is another program called Run Post Cost to General Ledger. And again, depending on the setup, it can be automatic or run as a batch job. So no matter what we do in Navision, we can think of some things hitting the general ledger immediately, which would be like purchases and accounts payable, revenue and AR. And then depending on the setup, the inventory side of the general ledger could be delayed or to, let's say, a night batch, or depending on that setup can be run automatically right then and there. But the fact is that it does in fact run adjust cost and post cost to general ledger, regardless of the setup. One is automatic and immediate, and the other is perhaps a batch job that would run during the night. And the setup is then, we look at the inventory setup, and there seems to be at least some confusion here, is that we look at over on that left-hand side, the first three boxes, automatic cost posting, expected cost posting, automatic cost adjustment. I'm trying to think of how to explain it here. When we run this program called Adjust Cost Item Entries, or if we put in a inventory transaction, it creates something called a value entry. If we make that check mark automatic cost posting, it posts to the general ledger as soon as that value entry is entered into the value entry table. If we don't check that automatic cost posting, then we have to go to the second step of another program, post inventory cost to GL. The next check mark, it says expected cost posting. And while it is somewhat related, it really is a question if we want to put something called, I'm going to call it intermediate or interim entries into the general ledger. So the choice really is, should I, let's say when I receive a purchase order, should I make a general ledger entry related to the receipt of that purchase order before I invoice? Automatic cost adjustment, I've set it here to always. And what that means, if I look at this setup, it says that if I invoice a purchase order, for instance, it's going to run the adjust cost program and automatically post any of the results to the general ledger with the setup. But if I were to choose something else, automatic cost posting turned off and automatic cost adjustment to never, then I need to go down into the menus then, and where it says adjust cost item entries, I have to run that, and then turn around right away and run post cost to GL. Up until version 2013, these were quite important depending on the transaction volume in your company. If you're really, really high transaction volume, you could end up with very slow performance, table locks, and a lot of angry people. But as I find out in 2013, NAV 2013, they've made the posting routines much more efficient. And so it might just be we could always turn on automatic cost posting and adjust cost always and not run into those performance issues. But I'm still waiting to see that. We've done some 2013 implementations. Haven't heard any word about performance, but maybe it's all good. Maybe we'll never have to worry about this again. Now, by way of explaining the Navision costing process flow, I'm using something here called P accounts, and I'll go through these to show you how it works. And this is, I've just done it for a distribution company to keep it simple. But if we look at transaction number 1, inventory received, and going back to my setup here, I've got expected cost posting turned on. What we get then for just an inventory receipt is a debit to this interim inventory account and a credit to what I call accrued accounts payable. And again, expected here if it's FIFO or LIFO or average, and expected over here. Now, when I process the invoice, Navision calls it invoicing. Most people call it vouchering. When we voucher or invoice it, then the first thing that it does is backs this transaction out. It reverses this transaction and then does something that most of us would not understand coming out of an accounting class. When we come out of an accounting class, we would say that when I receive an invoice inventory, I'm going to debit inventory and credit accounts payable. Well, Navision doesn't do it that way. What Navision does is puts a credit to the accounts payable for the actual cost amount, and it debits an account called the purchases account for that actual amount. Then it turns around and credits an account called direct cost applied. I sometimes call it purchase offset or inventory to balance sheet. It credits that account number and then debits the inventory account. So instead of credit AP, debit inventory, it credits AP, debits purchases, credits direct cost applied, debit inventory. Very different than we would have learned in school. Now, the next thing is I say in transaction number 3, inventory shipped. I'm crediting an inventory account. Actually, I should have been more careful because there's another account called interim inventory. It would have come out of there. But I'm debiting this account here, and I've circled it because it was part of the description of this webinar. Cost of goods sold interim. So when I make a shipment but I don't invoice it, I'm crediting inventory and debiting cost of goods sold interim. And I would say that more than half of the time when I go into a company to help them out, straighten out their costing, they will have this cost of goods sold interim on the P&L, which makes a lot of sense because everybody knows cost of goods sold belongs in the income statement. But the fact is that we leave it on the balance sheet because what it is inventory that's no longer in the perpetual inventory. I can't see it on hand if I look at an item card. But at the same time, we haven't recognized the revenue, So it just goes over into the balance sheet into another account number called cost of goods sold interim. Now, when I invoice that sale, I reverse this out. I credit a cost of goods sold interim, put it back into inventory on the debit side, and take it then from inventory to the normal cost of goods sold, and I have my accounts receivable and revenue. So there's a little hint that if we've got consultants on the phone or anybody setting up Navision for the first time, is that cost of goods sold interim belongs on the balance sheet. Now, I started out here with this is the T accounts and the process that it goes through, but now the question is, how do we set that up in Navision? And it's something called posting setups. And in this one is called the general posting setup. If I look at this first column, it says general business posting group, and I call that the who part of the transaction. The general product posting group, I call that the what part of the transaction. So if I purchase something, then the question is, what account numbers are affected? So the purchases account here, that direct cost applied here. Sales account is the revenue account. Cost of goods sold is cost of goods sold. Cost of goods sold interim, that balance sheet account, and that accrued accounts payable. So what I'm showing is it's that posting group setup that we look back here to say, okay, we've made all these transactions. How do we tell Navision where we want that to go in the general ledger? And one side of it is called the general posting setup. On the inventory side, inventory posting setup, it really is then a combination of where, which is locations, and what, like raw material. So I could have locations with finished goods, locations with raw material, locations with intermediates or sub-assemblies. But then I have the inventory account, which is here, that I took from my T accounts, and the inventory interim here. So skipping back a couple slides, following through with all of the T accounts. On one part, mainly the income statement part with that exception, and the cost of goods sold, I'm mapping to the general ledger. And then the inventory side, I'm mapping to the general ledger. So where do we get then? I said, here's location, and here is the who part. The what part of the transaction comes from the item card in this general product posting group, raw material. The who part of the transaction comes from either a customer card or a vendor card. So in this case, I've taken it out of that Cronus database, and I say the who is national and the who is national. So when I purchase or sell, it's going to be a combination of who I sold it to and what did I sell, which then in turn maps back to that general ledger through the general posting setup. And here's a hint that I'm actually working on it with a client right now, trying to reconcile their inventory. And I call this Bob's rule number 1. Never select direct posting on account listed in a posting setup. And I've made the statement in front of an audience to say, if you set up the posting groups correctly and you never allow direct posting to any one account numbers, it is not possible for the general ledger to be out of agreement with the inventory subledger. And people look at me with a stare, you know, like, what's this guy been drinking? If we never allow direct posting and we have our posting groups set up correctly, it's impossible for the general ledger to be out of balance with the inventory subledger. And that's been true for a good number of years. And so what happens, people will start doubting, you know, this is not right, and they'll make manual journal entries, in this case into account number 14300. They'll make a manual entry into that account, and then when you run the inventory valuation report, it doesn't agree with the balance in that account number. So if I'm helping somebody straighten something out, the very first thing I do is go into that balance, look for the entries, find all of the manual entries, exclude those from the reconciliation, and about 9 times out of 10, the balance left in that account number will agree to the inventory subledger. So if you have clients with direct posting check mark, tell them they're violating Bob's rule number 1. I got to remember what Bob's rule number 2 is. I remember. Bob's rule number 2 is, if we look at posting setups, what I want is every column in the posting setup, to have a different account number. That's a little stretch because sometimes people will say, well, my purchases account and my direct cost applied account, if everything's working correctly, they'll net out to 0. So why can't I make them both be the same account number? And my answer is, well, you can, but it's just a lot easier to reconcile if the balance in those account numbers is not equal to 0. The next thing that really affects is something called allowed posting dates. There's the obvious part of it, where if we allow posting dates, allow from, in this case, I've got September 1 through September 30, 2014, and I've set my user to the same. What that means is that on a day-to-day basis, I'm not allowed to post into the general ledger anything before or after those dates. Just makes sense. The question becomes, and it happens very, very frequently, is that a client will run the adjust cost process and the post cost process, and it will post entries into a prior period. So the question is, how do I control when an adjustment in a prior period posts to the general ledger? There's one more piece that's part of that thing, and it's something called inventory periods. So if we look at inventory periods, allowed posting dates in that general ledger setup, allow posting in the user setup, the adjust cost program uses what's called the most restrictive of those dates. So for instance, if I had October 1 here, but September 1 here, then if we ran adjust cost, it would say the general posting setup is the most restrictive and would put the adjusting entries into the general ledger on October 1st. This is very, very, very important. So we take a look here, 9-1, 9-1. But the other part of this thing is something called inventory periods. Inventory periods are another part of that to decide. And so it would say if the inventory period, let's say I've got September here with a check mark is closed, it would say I cannot post into a closed inventory period, and we'll put the adjustments on October 1. So to repeat, it takes the most restrictive of allowed posting dates in the general ledger setup, or the user setup, or the inventory periods, and says use the most restrictive. I was trying to quantify how many questions I get related to this, or how many problems customers come to me with, clients come to me. I would say on the average of once a month, I find somebody with that. I ran adjust cost and it put it into the prior period. What should I do? And it's because they weren't paying attention to these posting dates and how they wanted them to work. There's another benefit of using inventory periods. And one of those is that when we go to close an inventory period, and I get an error message, perhaps, the inventory cannot be closed because there's a negative inventory for one or more items. Run the close inventory period test report to identify the item ledger entries for the affected items. So it's not letting me close an inventory period unless all of the problems in that period are resolved. So what I encourage my clients to use inventory periods and to close the inventory periods so that if there are problems, they will recognize the problems and correct the problems before going into the next month. It's just a nice way of keeping everything straight and the problems are resolved and not carried forward to the end of the year when you're really trying to reconcile inventories and satisfy auditors. The vision allows us different costing methods: standard, FIFO, LIFO, average, specific. I won't spend a lot of time here, but standard cost implies that we in effect tell the system what the value of our inventories are going to be, whether it be purchased raw materials or finished goods. FIFO implies, and I'm going to talk just a little bit about that. FIFO, in this case, I'm getting myself tongue-tied here. FIFO means the order in which I remove inventory from the item ledger table. So if I've put something into inventory with a purchase order, I put more in with another purchase order, it says use the oldest inventory first. On the other hand, if I use LIFO, it says use the newest inventory first. Average cost says, well, in effect, issue it out in FIFO sequence, but give it a value of the average value of what's remaining in the inventory. And specific means if I'm going to produce in quantity 1, and every unit that I have in inventory will have its own cost. And I think the application there would be something like capital equipment, very expensive, like if you're making an airplane or a locomotive. Each one would be in inventory with its own cost. So it's not trying to average things out. It says this very unit costs this much money. And then so how is standard cost determined? Cost accountants set the standard cost for purchased items. And that's an effort between the purchasing department and the accounting department. They're going to say, for the upcoming period, this is what we expect to pay for our purchase items. Then cost accounting, in conjunction with production engineering, will set standard labor and overhead rates. And the way you're going to do that, and I think you've all heard it, you're going to do some kind of a budget for the manufacturing department. You're going to figure out how many production hours or units you're going to produce. And if you divide the budget by the units or the hours, you come up with a rate that says per hour, this is how much money I'm going to charge production, or per unit, this is how much I'm going to charge production. Subcontractor standard rates for subcontract services, we set that up a bit differently in the vision. But if you have operations that are outside of your building, you would use the vision subcontracting. And there's a special way to set up the routing then so that the work center and the routing, so that we know that if we roll up standard cost, we're going to include that subcontract estimate. Then I say engineers construct bills of material, production engineers construct routing, and then when you have all of those things set up, then we do something called a cost roll-up. And I have to put a little plug in here is that there's a form and process in the vision called the standard cost worksheet. That is by far the best way to roll up standard costs when you're in the vision. You can actually do it from the item card, but it could leave you with a situation where you've rolled up and established new standards, but you've got item ledger entries in inventory, remaining quantity, with the old standard cost. If you use the standard cost worksheet, it at least creates something called a revaluation journal that you would use to revalue the inventory. So whatever is left in inventory is all at the new standard. And just a picture now then, I said, oh, we're taking item card information, we're taking bill of material information, we're taking routing information, we're taking work center information, and rolling that all up into a new standard. And I said, well, boy, this could be tedious if you had to do it one at a time. But on the bottom, the good news, we have this thing called standard cost worksheet, and the computer will do all of that roll up for you, filling in all of the appropriate fields in the item card, and then also creating a revaluation journal as necessary. So now I just want to do, I call it sample cost flows using P accounts. We already looked at one for a distribution company, but in a manufacturing company, we'll go through it and it shouldn't take too much time. And I'm using standard cost here this time. So when we receive in a purchase order for a standard cost purchased item, what we get then is a debit to the interim inventory account and a credit to the accrued accounts payable account at the standard cost, as opposed to if we're using one of the other costing methods, it won't be the standard cost, but it'll be the expected cost. But when we're using standard cost, it will use that standard cost. Now, the next step then is we've received that inventory, we've made that interim entry, and now we're going to invoice that receipt or voucher that receipt. And as before I said, it's going to credit the interim inventory and debit the accrued accounts payable. It's going to wash out that old transaction that we put in there, that placeholder. It's going to credit accounts payable for the actual amount, and it's going to debit this purchases account for the actual amount. Then it's going to credit the direct cost applied account for the actual amount, but it's going to put standard cost into inventory. And so we learned in accounting that you can't have an unbalanced transaction. So if the actual cost is different than the standard cost, we're going to post something called a purchase price variance. And it could be on either side here, depending. If we paid more, it'll be a debit. If we paid less, it'll be a credit. Now, the next step in manufacturing, and a lot of timing involved here, but eventually we're going to take purchase material and move it into work in process with something called a consumption journal or the production journal. And it's going to take out, I have here, bottom lines at standard. So I'm crediting that purchase material account and debiting the work in process account. The next thing is we're going to record, let's in this case say labor applied to that production. And correspondingly with labor, we're going to bring some overhead along with it. So we go to the output journal or the production journal, record the labor. We get a debit to the work in process account for that labor set rate, the rate that we put on our work center cards, and the corresponding amount of overhead. And with our debits in the balance sheet, in the P&L, we have an account called, in the vision we call it direct cost applied or indirect cost applied. So we're debiting work in process and crediting these two account numbers. The general terminology for crediting these account numbers in the P&L is called burden absorption. So what we're doing, what we're trying to do, it's got manufacturing expenses from all sources. They could be maintenance, salaries, depreciation, electricity, power, all of that manufacturing expense is coming in. And in this way, by setting these rates, we're in effect taking some of that manufacturing expense and moving it up to the balance sheet. So we could come in here and say individually manufacturing is how much electricity went to production, how much maintenance went to production, how much spare parts went to production, how much vacation time went to production. It would be way too hard, way too tedious. So we set up some rates and then use these burden absorption account numbers to take that off the P&L and put it on the balance sheet. Another fancy term for that is capitalization of manufacturing expenses. The next step we use in the vision in either the production journal or the output journal is we're recording the finishing, I shouldn't say finishing, I should say completing of production. We're taking it out of work in process, and we're moving it into the finished goods inventory. I've made this all one step here just for simplification and presentation. There are actually some interim steps that go on here, but for now, let's just go with this. So I take it out of work in process at standard cost, put it into inventory at standard cost. But the question is, did I use more or less material in my production than what the bill of material and standard cost called for? Or did I use more or less labor in my production than the routing and the associated rates called for? So if the answer is I use more or less material, when I change status to finished on a production order, it's going to calculate something called production variances. And one of those variances here is called material usage variance. And I could either get, if I use too much, I get a debit, and if I use less, I get a credit. And the same way with, I called it here, labor efficiency variance. If the routing called for an hour and I took 2 hours to do my production, overhead variances, they kind of just tag along. So if I have a poor labor efficiency, I'm going to get a debit here and a debit here. And if my efficiency is good, I'm going to get a credit here and a credit here. Now, well, I threw this one in there. One night I was sitting in a hotel trying to come up with a nice presentation. It took me about an hour to figure out how to get all these lines in here. So I always leave that slide in here because it really is showing what's known as the value added. So what I'm doing is taking purchase material and I'm adding labor and overhead to that purchase material into work in process and then coming out at standard. So there's this concept called value added, and these two lines right here are really the illustration of that accounting value added. So then we can make up an income statement based on what we put into the general ledger. And so if I could even flip back and forth, I've got a revenue account, cost of goods sold account, variance accounts, et cetera, direct cost applied account. And then so in my standard cost income statement, I take the revenue minus something I call standard cost of sales. And again, I'm just plugging in a word here called standard margin. There's a lot of variance in the variation in the vocabulary that comes to that. Then we start plugging in these variances. So if I'm favorable or not favorable, purchase price variance, labor efficiency variance, material usage variance, and I subtract out my payroll expense. I subtract out all of my manufacturing expenses, and I add back in the direct cost applied, indirect cost applied, which are these two account numbers. And I added this after a while here. I said plus or minus inventory adjustments. So if the stockroom is taking cycle counts, you could be writing off material, so that could affect your performance. And so net sales minus standard, and I call these adjustments to the standard cost of sales to yield something that I call manufacturing margin. Some people call it contribution margin. And then the selling and marketing expenses, G&A expenses, and you come down to EBITDA or bottom line. So by tracking through all of these T accounts and that manufacturing flow, at the end of the month or the end of the quarter, end of the year, it all comes out into something called the income statement. Now, early on I say, why are we doing this? Well, I'm giving information to management. Your purchase prices, you're paying more than we expected. Labor efficiency is not as good as we expected. Payroll expense is way high. Manufacturing expenses is way high. We're not producing much, so we're not getting much direct cost applied. So all kinds of information just comes right out of that little piece of the P&L. And then hopefully management would take action based on what they're seeing here. And then the next month, the next year, they're able to make a bigger manufacturing margin and then hopefully a bigger profit. Now, what I had done there before was for the standard cost. It's quite similar for any of the other ones, average, LIFO, FIFO, where go through the whole purchasing process. I do a consumption journal that takes the BOM lines, but now instead of taking BOM lines out at standard cost, taking them out of inventory, I'm taking them out at their actual cost. This is exactly the same, labor and overhead at the set rate. I'm taking those and putting them at the set rate. And when I get done with my production, I'm taking it out of WIP at the actual cost, putting it into the finished goods at the actual cost, out of finished goods at actual cost, into cost of goods sold at the actual cost. Now, when I produce an income statement, it's going to be a lot the same, except we don't deal with any of the variances. And so depending on the company and the accounting philosophy policy, if we're using standard cost in manufacturing, we can provide some more detailed variance analysis. But in the other costing methods, really what we're doing is mainly, it's called margin analysis, because we know that we made more or made less, but we don't know, was it because of paying more for purchases, labor efficiency, material usage? So in a non-standard environment, we lose some of that manufacturing management information. So then we come down to the title of the presentation. I call it Keys to Success. And I even highlighted the one up here in the upper left. I said inventory on-hand accuracy. If we set up everything perfectly, if we got our costing in there perfectly, if we're invoicing perfectly, we're doing everything perfect, except we don't know what the accuracy of our on-hand inventory is, then it's all just kind of, why bother? And somebody will say, well, our inventory is about 90% accurate. And I say, okay, that means you're showing $1 million in inventory. That means that your inventory is anywhere between $900,000 and $110,000. And they say, I see your point. My point is that inventory accuracy really matters a lot. And if you can't trust the inventory accuracy, then all you can do then is wait to the end of the year, take a physical inventory, and then make all of the adjustments at physical inventory time. It's really not the time to do it, because all year long you've been projecting that you're going to make a profit, but then you go out and take a physical at the end of the year, and you could very well blow away the whole profit just by counting less inventory than you thought you had. The next one, and this is equally important, I think, completely understand how the system works. This is another one of those ones where I'll go into a client and start talking about helping them out fixing their inventory valuation problems. And they really don't have a good handle on how the system works. They don't know the posting group setup. They don't know the relationship between item ledger entries and value entries. They don't know how and when to run adjust cost item entries or post cost to GL. And once they understand how it works, then all of a sudden things start to make sense to them, and they're able to then make those corrections and get the inventory, or pardon me, the accounting accuracy better. Another one is avoid negative inventory. I don't say don't have negative inventory, because it's really a culture shock to some companies that at the end of the month they're out there shipping like crazy, and if we were to say no negative inventory with a program change, then it would stop shipping because of timing issues, getting things out of production. But the bottom line is avoid negative inventory, because there's no way that Navision can calculate the value of something correctly if you have negative inventory. And that's particularly true in average cost. In average cost, if you let the inventory go negative, then the average cost calculation goes crazy. The next one, reconcile inventory subledger to GL frequently. And there are 2 reports that I run, actually 3 reports that I run. One is called the inventory to GL reconciliation. And what I've discovered in European companies using the W1 database, that report is not in that database. So if I were you, European people, I would look for that report and get it in and use it. It's a very good report. The other report is inventory valuation report. And the third one is another one called reconcile AP to GL. Very important to stay up with your vouchering. Sometimes I'll go into a company to help them out, and let's say we'll run that report. And there's about 3 or 4 years worth of unvouchered purchase receipts. And without vouchering them, there's just no chance that the inventory valuation will be correct. Over on the right side, involve all necessary departments. Way too many times, the computer department, the IT department, will be running everything and trying to make things work. Or the cost accounting department will be trying to make everything work. You really do have to involve everybody in the company to make cost accounting work. Purchasing to make sure that they're helping us out with standard costs and getting those correctly. Inventory control to make sure that our inventory accuracy is right. Manufacturing to make sure that they're inputting transactions on a timely basis. Engineering, both from a bill of material and routing standpoint. And accounts payable to make sure that we're keeping up on our vouchering. And then I throw in this personal plug, involve a skilled consultant if necessary. So if you're having trouble and just can't find your way out of it, reach out to a consultant that's skilled in cost accounting, and they can help you out a lot. I throw this one in here, and this is, I make a joke out of it all the time. We have way too many accounting departments working at the end of the month trying to reconcile the general ledger and the inventory valuation. But again, if you're set up correctly with the posting groups, have some transaction discipline, and you don't allow posting to the computer accounts, there's no way that there can be a difference between the general ledger and the valuation report. Then I throw in another personal plug. Jason mentioned early on that I've been blogging, and so most of the things that I've covered in this presentation, I've written at least one blog on. So if you go into, I put Bing here, not Google, put Bob Bergman Blog, and it'll take you to my blogs, and you'll see that, and again, about most of the things that I said in this presentation, you'll find where I've written up some kind of a blog. With that, I think we're going to open it up to questions. And Jason, I can read some of the questions, but they're quite tiny over here. Do you want to read them back, or?
Sure. So yeah, please do enter your questions now on the right side. We had a couple people asking about access to these materials afterwards, and we are recording the session, so we'll make that available to you once it's posted on our website. We had a question, Bob, about from the Keys to Success slide. What if you could review those report names again?
See, what was it, Jason?
So the question was, can you go over the report names again that you had on?
Oh, the report names.
On the previous slide.
Yeah, there are many more reports, of course, but the ones in particular that I use for month-end, year-end inventory reconciliation, the main one is called Reconcile Inventory to General Ledger. And again, I was surprised when I hook up with a European client and I say run that report, and we look in the database and it's not in there. But I do know that if you ask for it, you can have that report added to your system. The other one is just simply the inventory valuation report, very valuable. And the other one is reconcile accounts payable to the general ledger. And I think it's also true that if I look in a European database, I won't find that report. But I do know, in fact, that if you ask your partner, they can get that for you. I can read one here from Winnie. I found it useful, but as a developer, it will take me a bit longer to get these accounting ideas. Will the slides be available? And I think the answer is yes. But Winnie, if you're in the United States and going to the NAV meeting in a couple, 3 weeks, I'm actually making a presentation called Manufacturing Accounting for Non-Accounting Professionals. And if you're in the US and going to go to that NAV meeting, perfect for you.
All right, great. And I think we have another question in here. Just some folks saying thanks. Thanks for the information. Yeah, I mean, Bob, I would be interested in maybe if you could share just a bit more of your thought on what some of those main considerations are maybe that you would be discussing in a full session. You know, if you are a developer and you need to get a better grasp on some of these concepts, are there any sort of top-line recommendations that you could share?
Yeah, but hang on just 1 second, and I'll come back to that. I was reading one from Mirko. How do you comment report cost shares breakdown? It's not multi-level. There is one Mirko report called rolled up cost shares, and that one is multi-level. Look forward to the documentation. Thanks, Anthony. All right, so these keys to success, again, they're just, without inventory accuracy, just forget about it. You're trying to say I've got $1 million worth of inventory, but if you go out into the stock room, here's how I judge a company when I go into a company to do a consulting engagement, and I walk out into the factory or into the storage area, and it's messy and things are piled all over the place and not labeled very well. I can just predict that they're going to have a very difficult time either in their implementation or knowing what their inventory valuation is. On the other hand, when I go into a company, and everything is nice and neat and ordered, well labeled, everything is on a storage rack, nothing on the floor, then I can make the judgment they're going to have an easy implementation, and I bet their inventory accuracy is very, very good. And I'm surprised sometimes, but 9 times out of 10, just that when you walk through the door out into that production area, you can make a judgment that it's going to be an easy implementation or a hard one. Don't underestimate the completely understand how the system works. Believe me, I'm not sure. I have to be careful how I say it. Is that after I've done training in a company about how the system works, as it turns out, it's not that difficult. It's not like Navision has invented a new way of doing cost accounting. But once I explain that, how the system works, it's a relatively short period of time before the inventory valuation issues and cost accounting issues are sorted out, and they become very happy. I always make the joke, I said, we're going to have accounting playing golf on Friday afternoon instead of sitting in here trying to figure out what the inventory is. We have some very big companies, very large, high transaction volumes, in particular in the food production area, where they're producing millions of cases of food, and the inventory valuation and cost of goods sold, we've got that down to, it's kind of an afterthought. They just run the reports and check it and everything's okay. They don't spend days and days and days trying to reconcile. But a year or two ago, the answer was it was out of whack, but all of a sudden we got it straightened out to the point where it just plain works. Negative inventory, again, you can just imagine trying to value something and it has a negative inventory. So what kind of a value do you put on the negative? Because there's no way of knowing what the value of the positive entry was that would have supplied the negative if there's no positive entry to supply it. Reconciliation, do it often, at least once a month, but maybe do it twice a month. Big one, stay current on vendor invoice vouchering, because without invoicing the purchase orders, there's no way that you really know the true cost of production, because what's going through is an estimated cost in the beginning, and then by vouchering it, then you will know what the actual cost is. And accounts, manufacturing accounting, cost accounting, don't go it alone. Bring in everybody from all of the departments and make sure that they're helping you. Because again, I've seen it way too many times. I've even seen it where the IT department is in charge of cost accounting and running the reports and making everything balanced. It just doesn't make any sense. You need everybody in there. And then, of course, if you need some help, give me a call. Do we have any more questions coming in?
All right. Well, Bob, I think we are through the questions here. Thanks, everyone, for your input today. And There is an evaluation right now, so if you could fill that out, I know Bob would appreciate it, and we definitely like to hear from you and how these sessions go, what you'd like to see in the future as well. So Bob, thanks so much for joining us today.
And thank you for asking me to participate. Thank you very much.
It was our pleasure. And thanks to everyone in the audience, and please stay tuned for more sessions coming up soon. Thanks a lot.
Goodbye, everybody.